All right, let's just jump right in. What is the single most important thing schools should be teaching us about money? Is it, I don't know, how to calculate the area of a circle, or is it something a little more practical, like how to avoid drowning in debt? That question is at the heart of a massive debate that's been blowing up online, and today we're going to get to the bottom of it.
And this all really kicked off with this simple, but honestly really powerful idea from a Reddit user. Their argument is pretty straightforward. For most of us, day-to-day life is a financial battlefield, right? It's not a calculus exam. We need to understand mortgages, not abstract matrices.
And look, the stakes here couldn't be higher. The original post threw out this number, $90,000, as the average American's debt. When you think about mortgages, student loans, credit cards, it all adds up. And it's a pretty stark reminder that financial mistakes have very real, very heavy consequences. So this really frames the whole thing as a question of priorities. I mean, we only have so much time in school, right? So what's the stuff that everyone needs to know versus the stuff that's maybe better left for the specialists? Here's the trade-off in a nutshell. On one side, you have the pillars of higher math, things that are great for abstract reasoning. On the other side, you've got the practical skills, budgeting, mortgages, credit card debt, that literally determine if you can afford a home or retire someday. The original argument was, why aren't the skills on the right given the same weight as the ones on the left? But, of course, here comes the first big counterpoint. Some people argue that these financial concepts aren't missing at all. They're just embedded in the math classes we already take. Compound interest, for instance, is just a real-world application of exponents. So the question becomes, is the problem that it's not being taught, or is it that we just don't remember it? And that leads to an even deeper point. Maybe the problem isn't about what schools teach, but about what they can teach. Think about it. You can explain compound interest all day long, but you can't really teach self-control from a textbook. So maybe the issue isn't knowledge after all. Maybe it's all about behavior. And that, right there, is the real heart of the issue. We all know intellectually that credit card debt is bad, but knowing the formula for an interest rate doesn't stop an impulse purchase, does it? So is the problem really our spreadsheet skills, or is it something deeper inside our own minds? Okay, so this is where we're going to take a sharp turn. Let's just forget the debate about calculus versus budgeting for just a moment. What if we've been asking the wrong question entirely? What if the biggest financial variable isn't in our textbooks, but in our psychology? So, welcome to the fascinating world of behavioral finance. This is a field that basically combines economics and psychology to understand why we, as supposedly rational humans, make such consistently irrational decisions with our money. Essentially, traditional economics assumes we're all logical robots, just calmly trying to maximize our wealth. But behavioral finance looks at reality and says, nope, we're emotional, we're biased, and we're often predictably irrational creatures. You could almost call it the science of financial self-sabotage. As the legendary investor Benjamin Graham put it, the biggest risks aren't market crashes or bad stocks. The biggest risk is staring back at us in the mirror every single morning. Let's look at one of the biggest psychological traps. It's called loss aversion. And this isn't just a feeling, it's a quantifiable bias. The sting of losing $100 feels about twice as bad as the joy of finding $100. And that one simple fact just warps almost every financial decision we make. This table makes it crystal clear. Gaining $100 gives you, let's say, 1 unit of happiness. But losing that same $100 hits you with more than double the amount of pain, over 2 units of pain. This asymmetry is exactly why we hold on to losing stocks for way too long, because selling would mean making that painful loss real. And here's another classic trap, anchoring. This is when we get a number stuck in our head, and it influences everything that follows. For investors, the most dangerous anchor is usually the price they paid for a stock. They'll say, I'll sell when it gets back to what I paid, even if the company is fundamentally worthless now. The anchor, not logic, is driving the decision. So what happens when you combine all these biases, loss aversion, anchoring, the herd instinct, and just throw them into the chaos of the stock market? Well, you get a wild, emotional, and often very expensive roller coaster ride. This is one of the most famous diagrams in all of behavioral finance. It maps out the psychological journey of the average investor through a market cycle from these thrilling highs all the way down to the devastating lows. Let's start at the top, near the peak of maximum financial opportunity. Everyone's talking about money. The news is euphoric. This is where FOMO, the fear of missing out, kicks in. You see the trend and you jump in, often right before the top. This is the herd instinct in action.
But as we all know, the market doesn't go up in a straight line. The path is winding, it's unpredictable. And when that initial optimism meets the cold, hard reality of a downturn, our psychology really takes over.
And here we are, at the bottom, the point of maximum financial risk, but also the point of maximum pessimism. After seeing all those losses, our loss aversion just screams at us to make the pain stop. So what do? We sell everything, often right at the absolute bottom, locking in our losses just before the market starts to recover. This whole ride is powered by a whole host of these biases. You've got overconfidence at the top, the herd instinct driving us to buy high, something called the disposition effect, which makes us hold losers too long, and then hindsight bias at the end, which convinces us we knew it all along, which of course prevents us from actually learning from our mistakes.
And this isn't just a theory, it has a real cost. This number comes from a famous study showing that, on average, the emotional roller coaster of buying high and selling low causes individual investors to underperform the market itself by a huge margin. Our own psychology is literally costing us money. So if the problem isn't our math skills, but our own minds, what's the solution? Are we just doomed to repeat these mistakes forever? Well, the good news is, according to behavioral finance, the answer is no. We can fight back. Here's a path forward. The strategy is simple, but it's powerful. First, you have to name the bias. For instance, realizing you suffer from home bias. That's where you irrationally prefer stocks from your own country. Second, you apply a conscious countermeasure, like deliberately diversifying your portfolio globally. And third, and this is the most important part, you stick to a systematic plan. That plan acts as a shield against your emotional impulses in those moments of panic or euphoria. And so we come full circle. Maybe the debate was never about calculus versus budgeting. Maybe the most important financial education we can possibly get is learning about the flawed, biased, and emotional computer that's running between our ears. The ultimate challenge isn't solving for X, it's about solving for you. The real question is, are you ready for that test?